Hi guys, this is Dale with the insurance. Today we're talking about it's an article and a topic that I think it's fairly intuitive. A lot of us may already know it, but there's a technical term for it. It's a particular coverage that applies to just about any asset, but typically homes and automobiles are the largest categories. The title of the article is "What is Forced Placed Insurance?" Right? And um, when you hear the definition, it'll make total sense. So let's say you are purchasing a car or a home, right? And you approach a credit union or a bank to help you finance this large purchase, right? You then have another party that has a vested interest in that asset, right? That asset isn't truly yours because obviously you entered a contract with said bank or credit agency to help you pay for said asset, home or auto, right? Part of that contract has a stipulation that this asset needs to be insured at all times. And they will stipulate how much insurance, but it's typically full coverage or up to the value of the home, blah, 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 blah. But either way, you can understand why the financial interest said bank or credit agency has in this asset, right? Now, the article gives a good example of kind of I think it's a young couple that falls on hard times and their insurance lapses, right? Anything could happen. But as soon as your insurance lapses, that said insurance companies sends out kind of a document, obviously to you, but also to the creditor, saying, hey, there's no insurance on this asset. Creditor then goes, because it's their asset, they want to be covered should anything, they've loaned out money to purchase this asset. Should anything happen to it, they would want to get paid back, right? Fair enough. So they go and place insurance on this asset because they obviously know the person, their client and partner, so to speak, within this contract has stopped paying. Something has happened where they no longer have insurance on said auto or said home, right? So they place, and it's called, it's formally forced place insurance, but it's also called lender or creditor placed insurance, where the creditor, the lender, just goes out and gets insurance to cover the asset, to cover their asset, their loan, right? And as you could imagine, the lender doesn't scrutinize this process, right? They're not going and trying to get the best deal or the best rate or the best value in terms of coverage versus the amount of money you pay. They just want this done. They just want it covered up to the limits. So as you could imagine, the price can be multiples, 4 to 10 plus times as much as normal insurance, right? They pay that up front and then tack it on your total loan amount, right? So that then your monthly cost shoots up, right? So this is precisely why you try to stay away from this ever happening. And even if you believe your insurance is going to lapse, contact your lender, see what you can do. Perhaps you can kind of loan or sell the vehicle back to them, or perhaps they have a program in which you can apply into to help you for a certain amount of time. But be proactive about it, because if you do not, and your lender does engage in forced place insurance, not only will it be more expensive, but this type of insurance literally just covers the asset, right? So if there's an auto, it just covers kind of like the theft of the auto, damage to the auto, hail damage to the auto. If it's a home, then it covers a fire or smoke damage to the home. It doesn't cover liability, right? They're literally not worried. And I don't want to say this in a mean way because it's business, but they're not worried about if you're driving the car and you hit somebody, right? Or you hit something. That liability lies on you dollar for dollar. There's no coverage. The asset, the car, the home, they are worried about because they loan money on that, right? So once again, intuitive, makes sense. But that's the formal term for kind of what a bank or credit union would do if they get the signal that coverage, that there is no coverage on the asset that they loan money out on, right? Force placed insurance, lender placed insurance. So much more expensive, no liability coverage, not a situation you want to get into. So if you're anywhere near having coverage lapse, be proactive about it. Contact your insurance company and your credit agency or bank and see what options are out there for you. Okay? Thanks for stopping by, guys. Hopefully this was helpful. We'll chat next week.
Hey guys, thanks for watching our video. If you enjoyed it, don't forget to hit the like button and subscribe to our channel for more awesome content. And if you really liked it, hit that notification bell so you never miss an update. We love hearing from you. We love hearing from our viewers. So be sure to leave a comment below with your thoughts on this video, and we'll see you in the next one.